After a brief video hiatus and a brand new background, we are back with another video for you guys. And to avoid a super long-winded intro, we are going to talk about one of the most important things, which is at the end of the week, how do we size our positions? How do we balance our portfolio between bullish and bearish trades to make sure that we're covered on both sides, because the market can move in any direction, to ensure that we're set up with a great portfolio and a great approach on Friday afternoon so we are ready for the week ahead. So how do we do that? Without further ado, let's get into it. Welcome back to the Hourglass Trader, where as time passes, we make money. So before we get into the nitty-gritty details, what we have on the screen right here is our profit tracker. And this basically is everything that we do, everything that we track, every single trade we've ever made. And it has two of the components that we're going to talk about in this video today that are very, very important to monitor to ensure that your portfolio is set up properly. The first is going to be the balance between bullish and bearish trades, which we have here in column C. And the second is going to be position sizing, which we have here in column N. So let's talk position sizing. Our initial position that we like to make is only 5% of our account. Now, the reason we like to do that is because it leaves us room to average in by doubling down twice on a position without it taking up too much of a percentage of our account. When we enter into our initial trades, we like to target a weekly return on risk, which is the option premium you're receiving divided by the at-risk amount, a weekly return on risk of 1% for a full-size position. Now, if we enter into a full-size position and it moves against us, it's tough because then we double down once and we're kind of out of room to double down again. So what we like to do instead of opening a 1% return on risk on a full size position is we start with a half size position and look for 2% return on risk or greater. From a dollars perspective, it's going to give us the exact same return, but from a defensive perspective, it's going to be a lot easier to average down into a trade and play defense if something moves against us. Again, we get the same upside potential, but the added benefit that we get is the fact that we can continue to average into the trade and play defense and roll and increase our position size. Increasing our position size is the single most effective thing that we can do as option sellers to manage our position when it's moving against us. So we really want to keep that bullet in the chamber, so to speak, as long as we can. So with that in mind, we like to start our positions with what we consider to be a half size position, so 5% of our account. Implication being that 10% would be a full size position. So if it moves against us, what are we going to do? We're going to double down. And at that point, it becomes a 10% position. So we've already started off the trade with what we think is going to be a favorable break-even price. We have had that move against us, and now we get to double down at an even better price. So for example, if we're selling a 20 strike put with the half size position and then the stock moves down, we now get to sell a lower strike. So if we were happy about selling a 20 strike put, we're going to be thrilled about the opportunity to sell a put at an even lower strike than that. So at that point, the position is only 10% of our account, and I will tell you 90%, probably plus, of our positions only need one double down, and they are very effectively managed. The second double down, again, we really want to hold off on doing this until we absolutely need to, but the second double down is very rare, but again, equally effective. So if we double down on a 10% position size, what we're going to get is a 20% position size. So at this point, it's moved against us not just once in a move that necessitated a first double down, but it's moved against us again in a move that necessitated a second double down. So two individual moves against us. And despite all of that, it's still only 20% of our account. Now, we want to understand that 20% of our account is still pretty large. Like, it's a fifth of our account. And as you could see from the beginning, overview of our profit tracker, if we zoom out, we like to hold a lot of different positions. So we really don't want one of these to be 20% of our account, which is, spoiler alert, you can see why this is highlighted red because it's 31%. So with that in mind, this is typically about the level that we like to cap things out. We have a really well-rounded approach, and what we don't want to do is have our returns in a given week or given month be too reliant on one position. The idea being that if we spread everything out equally, do what we're supposed to do, have a smart, disciplined approach, every now and then one or two are going to move against us, but the others that we have in our portfolio that we've managed properly are going to account for that, and we're going to be okay. So lesson one with position sizing, we start with 5%, then if we double down, we get to 10, and then if we really need to, we can get to 20. But the first line of defense that we always want is to roll down and roll out for a credit, That way we're not increasing position size. Do not increase position size unless you have to. Again, super key point, do not increase position size unless we have to. If you have to roll down on an option and break even on it, and for 1 week there's no progress, no profit, so be it, because things in the market can always get worse. So do not increase position size unless we need to, especially with how volatile the market has been lately. Now, one caveat that I will say to this is if you have a smaller account, you don't necessarily need to start out with 5% the way that we do, because that may severely limit you. For example, if you have an account that is $10,000 and you have limited yourself to positions that are just 5% of your total account, and we divide this by 100, it means you can only play stocks that are $5 or less. So to that point, what I would say is for step one, instead of 5%, maybe do 10. And instead of leaving yourself the option to double down twice, we just ignore that and we say, hey, we could start with 10%, move up to 20%, and then go from there and just cap it there and let the position ride. So I like 5, 10, 20 as the double. But again, smaller account, you could still very effectively sell options. Just make sure you at least leave yourself room for one double down. Please just leave yourself room for one double down if you want to try to employ the strategy that we are using. So with that said, that is how we approach our initial position sizing. And here's how that looks on our profit tracker. A lot of this can get really difficult because when you're putting trades into a brokerage, a lot of the trades are taking buying power out. And a lot of us use margin accounts to trade options. So just because something takes $2,000 of your buying power doesn't necessarily mean that the position takes $2,000 fully cash secured. What we want to do is be very mindful of how much of our account fully cash secured is sitting in these positions. You'll see this week we got pretty aggressive. We're at 91.1%. That's higher than what we normally do because that's in response to a dip in the market. And now what we have here in column N, as discussed earlier, is position by position, how large is each of our individual holdings. Now MongoDB was something from 2024 that carried into 2025. So this is a good example in this video where this is kind of like red light. We need to back out of this as quickly as possible. So for our trade plan for next week, we're going to move from 3 contracts back down to 1 contract and resolve this issue here. Celsius Holdings is one where we started with the half size position at 30.5. We added 28 strike puts, and now we've doubled down into it. And as you can see, we tripled down at one point, but have since found ourselves in a position that's going to expire worthless. So with 2 double downs, we get to that 9.18% position size. So green here generally indicates that we're on our first leg. We don't need to double down. And like we mentioned, it's very rare that we need to double down twice. Most of our trades here are on that first leg. Most of our trades here are profitable. And even if they aren't, like AMD and Win, for example, what do? We don't necessarily need to increase position size. We can just roll the strike down and wait for next week because a $106 or $116 loss on 1 contract for these is tiny. You can make that up within a week. Now, if AMD dipped $10, that may be a lot more difficult to recoup. So that is when we would double down. But again, biggest takeaway, do not increase your position size unless you need to, and make sure you leave room to double down into a position because that's the most effective way that you could manage it. So that rounds out how we approach position sizing. So the second thing that we want to keep a focus on is the balance of the bullish trades versus the bearish trades in our account. If we have a good, well-rounded option selling portfolio, we want some positions that benefit when the market go up, and we want some positions that benefit when the market goes down. That way we're not too reliant on moves one way or the other in the market, and I feel a more delta neutral, meaning, it is not necessarily dependent on the market moving up or down. A delta neutral portfolio is one that works very well when you're selling option premium. So let's take a look at our current profit tracker and see how we have approached that. We have 1 bearish Palantir trade, but if I'm being honest with myself, those are naked calls. We're not going to be doing that very much, and it's probably not the smartest move. So that kind of begs the question, HT mentioned that it's great to have a balance of bullish and bearish trades. Where are the bearish trades? So we have a different section in our profit tracker down here, which are longer term holdings. You'll see that these all have expiries outside of the current week. And at the time of this filming, the current week expiry is January 3rd. So these are January 17th expiry credit spreads. And what's great about these is they help balance out our portfolio. And if you know anything about credit spreads, we know that they have defined risk and defined gains. So if the market keeps ripping up and up and up, guess what? Our current week bullish portfolio is going to do great. And these losses will be limited to an extent because these credit spreads have max losses. However, if the market does start to move downward, as it did in this first week of 2025, where the S&P 500 is currently down about a couple percent along with NASDAQ, we want some positions that are going to benefit. And this is where we like to house all of those positions. I personally like to try to identify trades that I think are overvalued. But again, just because something is overvalued, and this is a lesson we learn time after time after time, doesn't necessarily mean that it's going to go down right away. Just because something is trading at $60 a share and overvalued doesn't mean that it can't get up to $80 a share and be even more overvalued. So the biggest thing that we want to do with these bearish trades is give ourselves time to wait. So looking back at this, these 117 expiries give us that. Today is January 2nd. These expire in 15 days. And what I like to do is keep bearish trades rolling on a monthly basis. That way we open these things up with 3-ish weeks until expiry. If they move in our favor, like we've seen with Tesla, like we've seen with MicroStrategy, like we saw with Carvana just today, we can take early profits. And we've taken so far a little bit over $2,000 of early profits. But if they move against us, what can we do? We could roll the position. We could manage. We have time to just sit back, put our hands up, and wait for it to move in our favor, because 3 weeks in the market is a decent amount of time. So this is how I like to handle the bearish trades in my portfolio. It's not that we should never have any bearish trades. It's more so that if you try to play these spreads on a weekly basis, if you try to play bearish trades on a weekly basis, the losses can compound very, very quickly. And what do I mean by that? We have an example of a trade right here, RGTI, which has moved against us a little bit, and at current prices is going to lose us $3,000. Now, you average that out with all the other bearish stuff, we still net out to like a $6,000 profit, but this is an example of a trade that's going, it's ongoing for a few weeks, and it's going to be about a $3,000 loss. If we had these spreads open for 3 to 4 weeks, as we will, and take a $3,000 loss, that's less than a $1,000 loss per week on the name. Now, looking back at 2024, this is something that we did not do very well. So if we go back to the end of the year, what we'll see is we started chasing spreads. We started chasing some stocks. Like Palantir is a really, really good example of something we did very, very poorly on. So at the end of November-ish, we look at Palantir. We have these short shares. It loses us $2,200. And remember, let's keep in mind that RGTI trade that we just looked at is kind of similarly sized off the bat, and we are on track to potentially lose $3,000 in a month. Again, less than $1,000 a week. We look at what we did with Palantir. Because we didn't initially use credit spreads, because we initially started doing this on a week-to-week basis, we lost $2,200 at the end of November. The very next week, since we didn't use credit spreads, we kept short shares, and we did it on a weekly basis. We lost $9,300. So in 2 weeks on Palantir, we lost $11,500. Now, again, we made like $1,700 back, $690 back, yada, 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 and then lost 1.5 in the last week of the year. So the overall loss in, 3 to 4 weeks on Palantir was $10,700. Now, I don't say all that to scare you and make you think that, oh no, holding bearish trades is dangerous. Selling naked calls, having the short positions like we did was dangerous. That's why this occurred. That's why we ramped up such a big loss in such a short amount of time. But it's very important to talk about these losses to understand what we did wrong and how we're going to adjust the process moving forward. So that's why when we look back at our profit tracker, what we see now is just a bunch of credit spreads. So instead of finding ourselves in a position where if something moves against us, we've racked up a pretty big $10,000 loss on one stock in a month, we look here. Alternatively, we've had something move against us. It's $3,000 loss in a month. And again, we never like to lose money, but we have to understand a reality of trading in the market is that on certain names and during certain times, we are going to lose money. So when that does happen, we want to limit the damage. That is what these credit spreads do. And further, this gives us time to wait. If RGTI goes back down to 15 over the next 15 days, which it has plenty of time to do, all of a sudden we've only lost $66 on that position. So again, it offers us a level of flexibility and a level of comfort while also helping pad our portfolio when the market starts to go down. Because what we saw off this first week of the year, the market is down a decent bit. And while there are I mean, honestly, our portfolio did very, very well. In a typical week, for example, if we look at our S&P 500 shares, those lost money. Where does that get balanced out? It gets balanced out down here where we have, $11,400 of positions that are on track to make us that level of profit and help cushion the loss. So again, when we try to evaluate how large our account is from a fully cash secure perspective, because again, if the market has the bottom just completely fall out from beneath it tomorrow and we have to take assignment of everything, can we afford to do that? And the answer should always be yes, because one area in option selling where people get themselves into trouble is when they sell an amount greater than what their account can take assignment of. So when we think about this, we have 74% bearish trades from our long-term section, 17.8% from our front week for 91.96. That's under 100%. Is it a little bit large? Yes, I like to keep it around 50 or 60, but I think current market conditions kind of necessitate slightly larger. And then if we look at bullish, it's 91.1% front week and then 34.51% for a 125.6% allocation total. Now, this one I'm not terribly worried about because we plan to get out of this MDB position, which is taking up 31%, and that'll take us back down below 100. But generally, we want both of those numbers, the bullish number and the bearish number, to be below 100%. And right now, they're perfectly evenly balanced. And then one final point to make is that our bullish allocation, as we just added up, is slightly higher than our bearish allocation. What guides that? Should we have more bullish trades? Should we have more bearish trades? How do we make that determination? And to me, the best way to make this determination is by using the RSI level of the S&P 500. So we can see currently the 1-year chart has an RSI of 39.03, meaning that the S&P 500 is currently a little bit oversold. So in situations when the market is oversold, I like to have some more bullish trades than bearish trades. Similarly, when the market gets overbought, like we saw at the back end of 2024, I like to have a little bit more bearish trades than bullish trades. So that way, if things revert back to the mean, which they typically tend to do, that balance will work out very nicely in our favor. We always want to be long-term bullish in the market, but we understand, as we can see over the past year, the market kind of trades in waves. So we want to be long-term bullish, but sometimes it makes sense to be short-term bearish. Now, again, with RSI at 39.03, this is not one of those times, but again, that kind of gets back to the idea of, okay, we understand how to size our positions. We understand how we want to set up these bullish and bearish trades. And then 3, finally, using RSI of the S&P 500, we now understand how we want to balance the number of bullish trades with the number of bearish trades that we have outstanding. And using this profit tracker, this is actually a pretty good time to go through this because this is how we guide our decisions each week, right? This is our current week, but as we start to roll things, as we start to build our portfolio for the coming week, this is how we like to evaluate these things. We look and see what our bearish and bullish allocation looks like. We look and see what our position size is on each individual stock that we've rolled into the following week. And once we get everything from the previous week rolled into the current week or the upcoming week, then we go back to the drawing board and say, hey, are we happy with our bearish and bullish allocation? Are there any positions here that are sized too large? For example, AMD is at 10%, but that's because we've doubled down. It's yellow. It indicates that to me. But again, 10%, that's fine. We're at a very, very nice price point on a stock that I'm currently happy to play at that level. So no problems here. So that's about it for what we've got. If you've made it to the end of the video, thanks for watching. And hopefully you are now ready on Friday afternoons to have a better understanding of how you're going to set your account up on Friday afternoon or even Monday morning so that you can sit back, be mostly hands-off during this week, be prepared and ready for a successful week in the market as an option seller. Thanks for watching. And again, this has been Hourglass Trader. As time passes, we make money.